Bloomberg Audio Studios. Podcasts, radio, news.
The single best idea. It's an uneventful Monday before Christmas, the holiday season. It was really something today. Huge news flow. Of course, Paramount and Netflix, Paul Sweeney, huge help there. But just all sorts of other news flow out. In Japan, we're really focusing on look over the coming days, weeks, and frankly into January for further discussion of the Pacific Rim in Japan. It's simple there. Prices down on debt and yields up. That causes some real angst. David Kelly's aware of this. He drives global investment strategy for all of JPMorgan. Can't say enough about his work. He's been dead on non-farm payrolls, the decline there in the monthly labor statistics, even with a government shutdown. Here's David Kelly forward on GDP.
I think if it continued into the first 6 months of next year, then I think the Fed would ease earlier. But I think we'll see a little pickup, as I said, because of income tax refunds. I think we'll see a pickup in growth, and I think that will stench the bleeding for a while. But then, maybe later next year we do get rate cuts. But I want to make it clear: rate cuts won't fix anything here. The problems that this economy faces have got nothing to do with interest rates. Or interest rates being too high anyway. So yes, it may force the Federal Reserve into cutting more aggressively later next year if we don't sort of put some more artificial stimulus into the economy, which we may well do.
Classic David Kelly. I can't say enough how I agree with him. The media focus on rates, and you've heard me say this, is a parlor game, is borderline comical. I understand it has ramifications for those trading and betting on the future of Fed decisions, on the future of the American economy. But in terms of the mandate of well-meaning people, whatever the politics in Washington, how much is an interest rate strategy really affected? I go back to I went back and forth with David Gurr on this today as he spoke to Stephen Myron with Anne-Marie Horton. And I said to David, I said, the financialization of America tells me that any kind of conducive rate strategy is just fuel for the haves. And I stand with that. And of course, we see the markets today buoyant, to say the least. Lori Calvasina in today. Lori Calvasina here on the dynamic between large companies and less large.
It really started in September, right after back to school. AI jitters from people who were real believers in the trade and had been there but had sticker shock on valuation. I think I heard less about private credit concerns in December than I did earlier in the fall, but I think that's sort of in the back of people's minds as well. And frankly, this rally we had off of the April lows was faster and more powerful than any growth scare bottom that we've seen in the post-financial crisis era.
Lori Calvasina, optimistic. I do want to make one note. Janice taken up by Nelson Peltz's shop Treon today, the active manager out of Denver, Janice Henderson. And I just have to state, Tally Legere was in today with Wealth Capital, and his optimism here of up 15%, 16%, or even more for next year, just top of the shelf, extraordinary optimism with so many people out there relatively scared stiff. On podcasts, we're at Apple, we're at Spotify, and YouTube podcasts. It's single best idea.